Hi guys, Henry here from Investment for Expats. So just to continue on from the theme of our half-year reviews of major banks, we're going to do JP Morgan, and this is JP Morgan's annual report. What we've done is we've summarized it into the key points and some takeaways for your portfolio from what some of the biggest asset managers are seeing for the rest of 2023. So in summary, JP Morgan says that investors should look for high quality companies with a robust management and a strong dividend and good balance sheets. So what we've done is we've put a number of funds that kind of match what JP Morgan is saying, in that it is looking for high quality in a passive sector, that's Vanguard High Dividend, in an active, that is Morgan Stanley Global Brands. Now, if we have a look a bit deeper into these, the companies on the passive sector, so the Vanguard is 0.06%. It's got your companies like your ExxonMobil's, your Johnson & Johnson's, your JP Morgan Chase that just had a good Q2 earnings, Procter & Gamble. They're good companies, strong balance sheets, large cap. They've also got a good dividend on that. So if you're looking to align yourself with what JP Morgan are seeing for the rest of 2023, this will be a fund to look for, the Vanguard High Dividend Yield. Again, as we go down, PepsiCo, Merrick, Home Depot, Chevron, all big large cap companies making up the weighting because it's a passive fund. On the active space, this is obviously going to cost a bit more. It's a very popular fund. It's done very well over the last 10 years. Is the Morgan Stanley Global Brands theme. Again, it fits JP Morgan's ideology of what they're seeing for 2023, and that is good companies with good balance sheets. It has got various sectors, so unlike the high dividend yield, this is got more tech in it, as you can see from the top holding in Microsoft. It's also got Philip Morris. We spoke about this in a few articles, that it's actually diverted its core business away into healthcare, ironically. Also companies like Reckitt Benckiser, S&P, Visa seeing as a bit of value right now, and also some more pharma stocks in that. Again, due to the active management part of the fund, it does cost a bit more than you're going in your passive. Again, as you can see there, ongoing is kind of 0.86 if you compare that to Vanguard at 0.06 in the US dollar form. So that's what Morgan Stanley, in summary, are seeing, is look for those that are high quality. And also, if you want to go a bit more granular, look for alternative asset classes. Now, what we spoke about before is looking at funds such as quant funds for a bit of alternative in your portfolio. Now, why is this different? Quant funds and hedge funds, they look for absolute return. So they're looking for 12% a year, ideally in any market conditions. Whilst if you're going into a fund, say your Vanguard or even your Morgan Stanleys in the active funds, what they're going to do is they're going to compare themselves to relative to the benchmark, normally the MSCI World, if it's an equity fund. Quant funds also seem to have historically do well in times of volatility. So, for example, if you are seeing more downside, which a lot of these analysts are from the top asset management, what some of the key themes that we get is look for those companies with strong balance sheet, be more defensive, or look for alternative asset classes, come up in a number of the major asset management companies. So therefore, you want to look for hedge funds or even diversify into different asset classes such as structured notes that give you some protection if there is some market volatility. Hope you found that useful. We will do some more of the top management's half-year reviews just to go over their themes. We've got quite a few to go over: Citibank, RBSC, Alliance, etc. So we'll go through those in future videos. Hope you found this useful. None of this is specific financial advice. If you want that, go see a qualified financial advisor.